Hi everyone, it's great to be here. My name is Jack. Today I'm talking about what is the variable rate loan. Variable rate loan is type of the loans where the interest rate according to the change in the market interest rate. Unlike the fixed rate loans where the borrower pay the constrained interest rate, the variable rate loan comparison varying the monthly payment that change according to the market interest rate change. Usually the lenders follow the national index such as the federal lending rate of the London Interbank Offer Rate. If the specific index charge the lender adjustment, the interest rate of the much the index. However, the change in the interest rate charge the customer not district, but rather occurs periodically according to the lender agreement. Variable rate loan is a type of the loans where the interest rate the change with the change in the market interest rate. The variable interest rate is the pegged and the reference benchmark rate, such as the federal fund rate, is the London internal bank offer rate, plus of the margin separately determined by the lenders. Example of the variable rate loans include the variables mortgage rates or the variables rate credit card. How variable rate loans work. The variable rate loans is the back in on the specific reference rate of the bond benchmark index such as the London Internal Interbank Offer Rate. The RIBOR is the interest rate which is a bank that borrow from each other the rate obtained by the serving banks and getting information on the interest rate that is they pay when the borrowing from the instructions. On the alternative of the level, the prime rate is the country to the prime rate is used to the reference rate of the auto loans, the mortgage of the credit card. The rate is tied to for the Federal Reserve Fund rate, which is the interest rate is the charge of the overnight the borrowing to meet the Federal Reserve's policy. Every the LIBORs are the prime rate of the country are used to the starting point of the commercial lenders when the setting they are the interest rate. Usually the lenders of the charge consumer are the separate or the margin over the selected benchmark rate that generate to the profit. The margin is charged to the consumer will be the depend on the various factors such as the duration of the loans. Types of the asset with the consumer risk level of the credit score and the credit rating, the benchmark of the class lenders margin. Separate add of the produced the actual interest rate, the charge to the consumer. For example, the auto loans may the price 6 month LIB or the reserve plus 3% of its mean at the loans with the maybe or the benchmark. The rate is will the change at the end of each 6 month period. The 3% is the margin charged by the bank to the consumer. The benefits of the variable rates for the borrowers receptive to variable rate loans and the beneficial because they are the often the subject to the lower interest rates than fixed rate loans. Most often the interest rate tend to be the lower at the beginning and is will just over the course of the loan terms. However, during the period of the concession collections interest rate, the fixed rate loans tend to be more attractive than the variable loans, such as the cases of fixed rates loans come with the interest rate that remain the unchanged during the duration of the loans. From the lender perspective of the variable rate loans offer the greater value compared to the fixed rate loans. The from of the lender perspective, the variable rate loans offer the greater compared to the fixed rate loans. Fixed rate loans remain the fixed regulation of the change in the market. What is a variable rate mortgage? A variable rate mortgage is a home loans where is the interest rate is adjustable periodically to the reflected change in the benchmark interest rate. Mortgage lenders can offer the variable the interest rate interest on the home loan of the entire the term of the loans offered to the interest rate the mortgage at the combined with both fixed and the variable interest rate. The variable rate mortgage is adjusted at the rate that the above reference of the benchmark rate. However, the proper variables loans when they are the expected interest rate to the fall in the futures. They can benefit from the lower interest rate. Provide the cap with the variable rates borrow or the prospect for the rising the interest rate. It means that the maximum limit of how much is borrowed can be the charge regardless of the benchmark of the interest rate. Or the variable rate mortgage the structure. The variable rate of the mortgage the structure is a way to the include interest rate and the variable rate the margin high quality borrow may the qualify from the just in the index to the rate which is a pegged to the on the lender prime rate labor. The borrower can charge and interest rate is the mortgage that fluctuate with the change in the market rate. The loans market to the firms first borrower can the charge the variable interest rate throughout the entire term of the loans. Interest rate in the case pegged on the indexed rate plus on the separate margin determined by the lenders. Apart from the full terms variable rate loans, the variable interest rate can be the part of the hybrid loans. Examples are the just tables rate mortgage combine both fixed and the variable borrow to pay the fixed interest rate of the first 5 year of the loan's terms and the variable interest rate would be the reset each year with the base on the index of the rate of the reset with the rate. The additional resources SCF is official provide for the certificates banking and the credit analytics of the certification program designed to transfer for anyone to into the world-class financial analysis. In order to the help you become the world-class financial analysis to the advise you the career to the your full last the potential these additional resource will be the very helpful. Credit analysis the Federal Reserve the plotting interest rate and secure and unsecured loans. These are the variable rate loans. So today is enough about the variable rate loans. So thank you.